Katie Stockton mentioned hers here with Nvidia. And a look at the broader market levels. She's founder of Fairlead Strategies and a CNBC contributor. We know that Nvidia, Katie, and welcome, we know it's an important stock. How important? Is it when you look at it, is it as important as, I don't know, the 200-day average on the S&P? It could almost be that important.
I think it's doubly important because you have the footprint, right? Just the market cap is so sizable, and its influence on sentiment, right? So that's the big deal. Because I think the AI trade is something that's been driving the market. And if you feel like there's some crack in that, that's a problem. And that's going to impact market sentiment at a time where I would argue it's pretty fragile because the sentiment metrics are very bullish right now. They're not extreme, but we're close to those levels. So any hit to that sentiment should be pretty damaging, I'd say, to the major indices.
And it's, it encompasses AI, and it also factors into the performance of the Mag 7 over the past year as well, because a lot of that was AI related, and in Nvidia, every time you want to do AI, you're talking about it.
Yeah, without question, it's been an outperformer within the Mag 7. It's now up about 57% from the April low, which is remarkable. And you compare that to Apple. Apple's underperformed by comparison by a big measure. CRM, or Salesforce, which is reporting today as well, is about 20% above its April low. So it's coming into earnings pretty hot, is what I would say, and that creates a proof point for it, just from a sentiment perspective.
You don't even want to, I'm not going to ask you about what you're looking for fundamentals. That has nothing to do with what you do, basically.
But the reaction's going to be very interesting. Yeah, I mean, I think it's almost a lose-lose situation from a technical perspective, because if we see a gap up, the gap is probably going to look exhaustive, and on Friday, the stock would be prone to one of those counter-trend signals from the DeMark indicators, whereas if we see some kind of down move, if you zoom out on the chart, it's going to take the shape of a head and shoulders top. We all know what that is. And it's simply a manifestation of a lower high following sort of a neckline of support. That neckline is roughly, I'd say, about 100 on the chart. But there is support around 115. These are nice round numbers, thankfully easy to remember. And on the upside, the resistance is around 150. So with the stock close to 135, you realize that it's pretty much sandwiched between support and resistance, which doesn't help us a whole lot.
On Friday, we were sitting here minding our own business, and then we heard about the Apple possible tariffs and the EU possible tariffs. The market sold off, and I mentioned your name a couple of times because you had been, I don't know, you didn't discount the possibility of new lows.
That's right, yeah.
Now I think you might be wrong on this point.
I might be wrong for sure.
What do you, have you changed your
I haven't. So it's the long-term indicators that suggest we could go back to new lows. So this is not really my opinion. It's me respecting the indicators that are now on sell signals.
Ends up being your opinion because you say, well, Katie said this. And
Based on the factual evidence of the
things could hit the fan again July 9th.
It could, and it's
fundamentally.
Yeah, yesterday definitely surprised me to the upside in terms of the magnitude of that response to what I didn't feel like was amazing.
How far are we from new highs on the S&P? We're not that far.
Yeah, just 3.5% or so. But when you think about that versus support too, initial support is about 7.5% below. So it's just not a great risk-reward relationship right now.
Right.
For the S&P 500, for most individual stocks are pretty close. Look at Microsoft as one, right up against the highs.
Yeah.
Huge move, signs of upside exhaustion, momentum-wise. So I do think the risk is greater right now to the downside. And whether or not we go to new lows, it's almost splitting hairs, but I think it's a significant retracement we're in store.
It is in the cards at this point. The NASDAQ is up how much from the lows?
Oh, gosh, I don't know.
It was up 24% at one point. So
I know the S&P was about 23.
You don't think we're back in it? It's all clear and we're in a new bull. You don't think that?
No, we don't judge a bull market based on percentages.
Yeah.
We are more
That's how we characterize them, but yeah.
We do, that's right. And also there's more...
Like a recession. No.
Yeah, it's also duration and the impact on the indicators. And those indicators are mostly pointing lower. The similarities are there to about April, May of 22, which is unfortunate. Of course, we didn't see that bear market cycle end until October.
Yesterday we were thanking the bond traders for giving us numbers we can remember. That the 10-year, the 2-year, and the 30-year are all like just above or below these key levels. What does it look like to you? Let's start with the 10-year.
So today we're writing up actually treasuries because we have
You're what with treasury?
Treasuries. So we're writing up TLT.
Writing up.
Yes, in our research.
Okay.
And we're writing it up because it's interesting. So right up now near the lows, that TLT chart, it's poised for an oversold bounce as yields pull back. Now, this is all within the context of a neutral long-term range for yields and for treasuries. But we do think that there's short-term upside for treasury bonds. And what's interesting is not only do we have this counter-trend signal supporting an oversold bounce there, but that counter-trend signal is there also on the ratio of TLT to the S&P 500, which tells us that treasuries should have a phase of short-term outperformance versus equities. And you could imagine that that probably isn't a great tape.
Not a great. So you think they diverge? Equities and bonds diverge?
That's right, yes.
Why?
Yeah.
Because it's indicating a slowdown?
It's just the relatively overbought versus oversold condition.
So where's the 10-year could go where? To 4?
You know, 4.25 is right where the 200-day moving average is. It's acted as a bit of
It seems like the markets would like that.
Yeah,
because
it seems so counter to what...
Yeah, the markets got spooked by huh?
The correlations break up, but, you know, the market sometimes likes it, but these correlations are just not reliable on the short term.